whether it is 24 hours or 2 days, is less important than the principle. The principle is that the market's reaction to your entry must be favorable and swift. A stock that is truly ready to begin a great advance does not typically linger at the starting gate. It moves. A stock that stagnates, that churns back and forth without making progress, or that immediately yields to selling pressure, is a stock that is advertising its own weakness, or at least its lack of immediate readiness. To follow this rule is to demand that the market proves you right, and proves you right now. It is a shift from a passive, hopeful stance to an active, demanding one. The speculator is not a supplicant, begging the market for a profit. He is a professional, making a calculated commitment and expecting an immediate return on his investment of capital and judgment. If that return is not forthcoming, he withdraws his capital without a second thought and redeploys it elsewhere. He is a manager of probabilities, and a trade that is not immediately profitable is, by definition, a low-probability venture. This rule, then, is the ultimate filter. It is the gatekeeper that stands at the entrance of every trade. It separates the high-probability, correctly timed entries from the premature, hope-fueled gambles. It ensures that the speculator's capital is only ever committed to positions that are in harmony with the market's immediate current. It is the mechanism that enforces the discipline of timing, the foundation upon which all of Livermore's greatest campaigns were built. To adopt it is to take the first and most critical step away from the mindset of the amateur and toward the cold, calculated, and ultimately profitable world of the professional. To understand the profound power of Livermore's #1 rule, one must first understand what he was looking for in those first critical hours and days after entering a trade. The immediate profit was not merely a financial gain. It was a signal, a piece of vital information, a confirmation from the market itself that his timing was correct and his judgment was sound. But what did this confirmation actually look like on the tape? It was not just a single uptick. It was a collection of specific, observable behaviors that, taken together, told him that he was in harmony with the market's true line of least resistance. The first and most important signal of confirmation was the character of the move itself. A stock that is truly ready to begin a great advance does not do so timidly. It moves with force and conviction. When Livermore entered a trade at a pivotal point, he expected to see an immediate and decisive move away from that price level. A stock that churned back and forth, that hesitated and struggled to make progress, was a stock that was advertising its own lack of readiness. It was a sign that there was still significant resistance to be overcome, and to remain in such a position was to invite the unnecessary risk of a sudden reversal. This movement, he observed, should be accompanied by a distinct increase in volume. Volume is the engine of a price move. A breakout on low volume is often suspect, a sign of a lack of broad participation and conviction. But a breakout on a sudden dramatic surge in activity is a powerful confirmation. It shows that other market participants, the floor traders, the public, and perhaps other informed interests, are seeing the same thing and are acting on it. It is the market's own way of endorsing the move, of providing the fuel necessary for a sustained advance. Another critical sign of confirmation was the ease of execution. When Livermore was correct in his timing, he found that accumulating his line was a relatively straightforward process. If he was buying, he might have to bid the price up slightly, but the stock would be available, and the market would readily absorb his purchases without faltering. This was a sign of a healthy, liquid market with broad underlying demand. The trade felt right because it flowed with the natural current of the market. Conversely, if a trade felt like a struggle from the very beginning, it was a profound danger signal. If, in trying to buy a stock, he found that his own purchases were the only thing holding the price up, that the moment he stopped buying, the price began to sag. This was a clear indication that he was on the wrong side. He was attempting to single-handedly fight a tide of selling pressure. This was not a position of strength, but one of extreme vulnerability. The trade was not acting right, and therefore it had to be abandoned. This same logic applied to the behavior of the stock relative to its group and the overall market. Livermore was a firm believer in following the leaders. He knew that the great market trends do not happen in isolation. They are led by the strongest stocks in the strongest industry groups. Therefore, a critical form of confirmation for any new trade was to see sympathetic movement from its sister stocks. If he bought a leading steel stock at a pivotal point, he wanted to see the other major steel stocks also begin to firm up and advance. This harmonious group action was a sign that a broad, sector-wide move was underway. It was a confirmation that his judgment was not based on an isolated anomaly, but on a powerful, underlying current that was lifting all ships in that group. It provided an immense sense of confidence and security. He was not just in a single, correct trade. He was participating in a great, validated market movement. The absence of this confirmation was an equally powerful warning. If he bought a stock and it advanced, but the other stocks in its group refused to follow or, worse, began to decline, he would grow immediately suspicious. It was a sign that the strength in his stock might be a manipulative move or an isolated, unsustainable flurry of buying. A leader without an army is not a leader. It is a target. He would often sell a position even if it was showing a small profit if its group failed to confirm the move. Ultimately, Livermore's #1 rule was a complete, multifaceted diagnostic tool. The profit he was looking for was not just a green number on his ledger. It was a composite picture of market health. It was a decisive price move, on convincing volume that was easy to execute, that did not look back, and that was confirmed by the sympathetic action of its peers. When all these factors aligned, it was the market's own unambiguous signal that a great and profitable opportunity was at hand. This is what gave him the confidence to sit tight, to pyramid his position, and to ride the great swings for all they were worth. His confidence was not born of ego or hope, but of the accumulated evidence of the market's own behavior. He had a reason, a powerful and validated reason, for his conviction. This is the great psychological benefit of his rule. It replaces the anxiety of uncertainty with the calm confidence of a confirmed diagnosis. For the modern trader, this principle is as true today as it was a century ago. Before you commit your capital, you must demand that the market proves you right. Do not be content with a trade that goes nowhere or immediately goes against you. Do not hold on to a position out of hope. Look for the signs of immediate confirmation. Is the move decisive? Is the volume convincing? Is the stocks group acting in harmony? If these confirmations are absent, you must have the discipline to accept that your timing is wrong. Cut the trade. Take the small loss. Preserve your capital and your mental clarity. There will always be another opportunity, another day, another trade. But that next opportunity is only available to the speculator who has had the wisdom to survive his own inevitable mistakes. This, then, is the ultimate meaning of Livermore's great rule. It is a commitment to trading only the highest probability setups. It is a discipline that forces the speculator to act only when the market's own powerful forces are aligned in his favor. It is a simple but profound method for ensuring that when you are right in a big way, and when you are wrong in a small and insignificant one. It is not just the #1 rule for every trade, it is the #1 rule for a long and profitable career.